Welcome to the Coco Finance Podcast. I'm your host, Barry Gardner, and I'm thrilled to have you join me today. Whether you're a seasoned investor, a finance newbie, or just someone curious about making smarter money decisions, you're in the right place. Here on Coco Finance, we break down the complex world of finance into bite-sized, actionable insights that you can apply to your life right away. Each week, we'll explore a wide range of topics, from personal finance strategies and market trends to in-depth interviews with industry experts and inspiring success stories. My ultimate goal? To make finance not just accessible, but also interesting and, most importantly, actionable for you. Today we're diving into a subject that's often swept under the rug, but is absolutely crucial to your financial success: the psychology of money. You see, managing money isn't just about numbers on a spreadsheet or how much you have in your bank account. It's about understanding the emotions, beliefs, and behaviors that drive your financial decisions. This is the stuff that really matters because, at the end of the day, your mindset and emotions around money can make or break your financial future. So, let's start with a question. Have you ever wondered why some people seem to have a natural knack for saving money, while others find themselves in a cycle of debt no matter how much they earn? Or why you might find yourself making an impulsive purchase even when you know it's not the smartest move? These questions are at the heart of what we're discussing today. The way we think and feel about money is deeply personal. It's shaped by our upbringing, our experiences, and even the culture around us. And often, we don't even realize how much these factors influence our financial decisions. Let me give you a personal example. Growing up, I watched my parents handle money very differently. My mum was a saver, a classic rainy day mindset, while my dad was more of a spender, always looking for ways to enjoy life in the moment. As a kid, this confused me, but as I grew older, I realized that their financial habits were a reflection of their experiences. My mum grew up during tough economic times and was taught to save every penny. My dad, on the other hand, believed in living for today because tomorrow isn't guaranteed. These early influences shaped their beliefs about money, and inevitably, they shaped mine too. This brings us to a key point. The financial habits and beliefs we develop early in life can have a lasting impact on how we manage money as adults. And if we don't take the time to understand these influences, we might find ourselves stuck in patterns that don't serve us well in the long run. Let's dive a bit deeper into how emotions like fear and greed play into this. Fear, for example, can cause us to hoard money, avoiding any kind of financial risk. On the other hand, greed can push us to make reckless investments, chasing after quick gains without considering the potential downsides. Both of these emotions can lead us astray if we're not aware of them. Think about the last time you made a financial decision out of fear. Maybe it was holding on to a stock for too long because you were afraid of losing money, even though all signs pointed to selling. Or maybe you didn't invest in something because the market seemed too volatile, and you feared losing your hard-earned cash. These decisions, driven by fear, often lead to missed opportunities. Now, consider greed. Have you ever been so excited about a hot tip on an investment that you threw caution to the wind, only to regret it later? Greed can make us blind to the risks, and when the bubble bursts, we're left picking up the pieces. But here's the thing. It's not just about recognizing these emotions. It's about managing them. Understanding your financial psychology can help you make better decisions. It's about knowing when fear is protecting you and when it's holding you back. It's about recognizing when greed is driving you toward opportunities and when it's leading you into danger. This leads us to the concept of behavioral biases, which are basically mental shortcuts our brains take when making decisions. These biases can sometimes serve us well, but more often than not, they lead us into traps. One of the most common is loss aversion, the idea that the pain of losing is twice as powerful as the pleasure of gaining. This is why you might hold on to a losing investment for too long, hoping it will bounce back, rather than cutting your losses and moving on. Another common bias is confirmation bias. This is when we seek out information that confirms our existing beliefs and ignore information that contradicts them. For example, if you believe that a particular stock is going to skyrocket, you might only pay attention to news and analysis that supports that view, while disregarding warnings or negative reports. This can lead to a skewed perspective and poor decision-making. But it's not all doom and gloom. The good news is that once you're aware of these biases, you can start to counteract them. It's about being intentional with your decisions and not letting your emotions or biases take the wheel. One strategy is to set clear, realistic financial goals that align with your true values. When you know what you're working towards, it's easier to make decisions that support those goals, rather than getting sidetracked by short-term emotions or impulses. For instance, let's say you're saving for a down payment on a house. Every time you're tempted to make an impulsive purchase, remind yourself of that bigger goal. Ask yourself, is this purchase worth delaying my dream of owning a home? This simple shift in perspective can help you stay focused on what really matters to you. Another powerful tool is mindfulness. By practicing mindfulness, you can become more aware of your financial triggers, the situations or emotions that lead you to make impulsive or irrational decisions. Once you're aware of these triggers, you can start to respond to them in healthier ways. For example, if you notice that you tend to overspend when you're stressed, you can develop alternative coping mechanisms, like exercising, meditating, or simply taking a walk. Also consider creating financial rituals. These are small, regular practices that help reinforce positive money habits. It could be something as simple as a weekly check-in with your budget, a monthly review of your investments, or even a gratitude practice where you reflect on what you have rather than what you lack. These rituals can help you stay grounded and keep your emotions in check. Now, I know this is a lot to take in, but remember, the goal here isn't perfection, it's progress. Understanding the psychology of money is a lifelong journey, and it's one that will evolve as you grow and your financial situation changes. The key is to stay curious, stay open, and keep learning. So, as we wrap up today's episode, I want you to take a moment to reflect on your own financial psychology. What early influences shaped your beliefs about money? How do emotions like fear and greed show up in your financial decisions? And what are some small steps you can take today to build a healthier relationship with money? Remember, the way you think about money has a profound impact on the way you manage it. By becoming more aware of your financial psychology, you're taking an important step towards not just wealth, but financial well-being, peace of mind, security, and the freedom to live life on your own terms. If you found this episode helpful, I'd love it if you could subscribe, leave a review, and share it with someone who might benefit from it. Let's keep building this community of like-minded individuals who are committed to learning, growing, and achieving financial success together. Thanks for tuning in to the Coco Finance Podcast. I'm Barry Gardner, and I can't wait to continue this journey with you. Until next time, take care and stay financially empowered.